Evening, everyone. Good evening, everyone, and welcome to the Golden Charcha. This program is being hosted by the EIRC and our chairman, Mr. Vishnu Kumar Tulsyan. Myself, C. Amit Agarwal, the coordinator for the session, and I will like to congratulate EIRC and the chairman EIRC to start this initiative of Golden Charcha program. And I will request Chairman Sir to brief about the program and way forward. Thank you so much. Chairman Sir.
Ah, Thank you, Mr. Amit, being a coordinator of this program, and I welcome CA Mohit Bhuteria ji being the one of the speaker of today's session. Friends, this has been envisaged with the opinion, with the thought process that we will give the opportunity to all the chartered accountant who is across the Eastern India, being the remotest part of Odisha to the remotest part of the Northeast, so that we chartered accountant can put up their own skills before everyone, and we can create a knowledge bank and knowledge society in our region, so that we become more relevant and become more empowered. So this is the initiatives, and I also welcome each and everyone to this initiatives, and request each and everyone that please join the initiatives of EIRC, is a vibrant EIRC, so that we can create one mark and we can go ahead. With in this sequence, we will having the 3 days program in week. One is Monday, next is Wednesday, and next is Friday. So 3 days program in a week. And I request each and everyone, those who are interested to being the speakers or to being the coordinator, they may come forward so that we can give them opportunity. I am right now in Siliguri. I just got the confirmation of 2 or 3 persons from Guwahati and also from Siliguri, and they want to participate in this process. So this is gaining momentum across the Eastern India. It's a very good initiatives, and I request each and everyone please join further and make it more popularized across the India. With these remarks, the format will be 45-minute discussion on the topic by the speakers and 10 minutes question answer sessions, and 5 minutes if anything left then it can be covered. So thank you, Amit, for taking this initiative ahead, and thanks Mohit ji for consenting to be the part to be the one of the speaker for this NBFC, which is very relevant agent today. So with these remarks, I conclude, and I also have with me the regional council member CA Sutar. If you somebody can see here,
Yes.
you want to address, please say a few words.
Uh, Mohiji, very good afternoon. Amitji, very good afternoon.
Good
Thank you,
afternoon.
Chairman, for giving the opportunity to pinch in. And I congratulate and compliment Chairman's thought process on the team's initiative. And this initiative is more of connecting people through the platform with other members across the East, so that not only we share our expertise with other members, and but also to augment the small and medium farms, so that we stay relevant to the subject and to stay relevant to the profession. So I congratulate once again, and I give my gratitude to Mohitji to initiate this great initiative of Golden Charcha on the first ball. Thank you so much.
Uh, Over to Amit to take the proceeding ahead.
Thank you so much, Chairman Sir and Sutar Sir, for the briefing and giving us the way forward. Now, we will have a very insightful session planned for you all today, focusing on the crucial topic of NBFC, especially their NOF and the regulatory challenges they face. To guide us through this session, we are honored to have us with CA Mohit Bhuteria ji. Mr. Bhuteria is a fellow chartered accountant with an insolvency resolution professional as well as a registered valuer. He is currently managing partner of AC Bhuteria and Company. Mr. Bhuteria expertise is evident from his impressive achievement. He stood first in the accountancy finals in the Eastern region. He has been a special invitee to the Expert Advisory Committee of ICAI in New Delhi for the 7 consecutive years. He has also contributed significantly to the ICAI study group on guidance note and upgradation of existing accounting standard. Furthermore, Mr. Bhuteria is impaneled as a quality reviewer and a peer reviewer with FRRB ICAI. He has extensively experience presenting on the Companies Act to numerous corporate and has addressed various forums like ICAI, ICAI, and MCA on the topics such as taxation, company law, mergers, demergers, restructuring, etc. With his deep understanding of the regulatory landscape and practical experience, Mr. Bhuteria is exceptionally well equipped to lead our discussion further today. So, without any further delay, let us welcome Mr. CA Mohit Bhuteria to share his insight on the topic NBFC NOFM regulatory challenges. Sir, the stage is yours now. Thank you.
Thank you. Thank you so much, Amit, for the nice introduction. Very good evening to all. Compliments to the chairman EIRC, Mr. Vishnu Tulsyan, for starting this great initiative. So, thank you, Chairman Vishnuji, for inviting me to be a part of this discussion, for this part of this session. So, he has selected a very, very crucial topic for which I think many of us would have received notices by now as to why you have not achieved the net own fund of 5 crores. So we just go a little a decade, 2 decades ago, when this process has started, when in 1997, RBI had started the process of registration of NBFC for the first time, making it mandatory for all companies who intend to carry on financial business to get them registered. And the net own fund prescribed at that point of time was 25 lakhs. So if I recall, around 15,000 companies had applied for registration. Many of the companies could not achieve the net own fund of 25 lakhs, and that point of time, RBI had given them 3 years' time. It was, I think, in 1997, the process has started. January 2000 was the last date by which they were required to achieve net own fund of 25 lakhs. Thereafter, in 1999, RBI came out with a guideline that all NBFCs who want to apply afresh, newly formed companies have to have a net own fund of 2 crores. And then came 2015, and RBI thought it fit that the 25 lakh threshold was quite low and it should be increased to 2 crores. So gradually in 2 phases, they gave a timeline that by 31st March 16, you have to attain an NOF of 1 crore. By 31st March 17, you have to attain NOF of 2 crores, and large number of companies which failed to achieve the NOF of 2 crores by 31st March 17. Many of these companies faced deregistration, cancellation of their NBFC license. In sometimes around 2021, again RBI came with a framework known as the scale-based framework, and it mandated that existing NBFCs. We are particularly talking of ICC in case anybody has query relating to any other class of company, be it MFI or any other class, we can have a discussion. So I am confining my discussion mainly to ICC, Investment and Trade Company. So in the scale-based framework, RBI said that existing companies have to attain a net own fund of 5 crores by 31st March 25 and 10 crores by 31st March 27. So 31st March 25 has already gone. Now this time is behind us. So companies which have not attained the NOF of 5 crores by 31st March 25, few of the companies have got notices from Reserve Bank of India. Now time will decide as to how RBI will deal with these companies who have not attained the NOF of 5 crores. So let us again go back to 2016. So what had happened at that point of time, RBI realized that there are many companies which are doing only investment activities and they do not have any public funds, they do not have any customer interface. So based on requests received from the industry, RBI came out with a separate category of NBFC, which they particularly call a type 1 NBFC. All those companies which got license registration in 97 or prior to 2016, they are type 2 companies, meaning thereby they can extend loans, they can accept public funds to the extent you are permitted to receive as per acceptance of deposit directions. You can give loans, you can do investments. So both type 2 NBFCs could both accept loans, give loans, do investments, and do all any other financial activities. When it comes to type 1 NBFC, which RBI carved out in 2016, they said that In case a company does not want to accept public funds, directly or indirectly, there is no customer interface, and they are doing purely investment activities, these companies would have to have a net own fund of 2 crores. They would not be subject to rigorous registration requirements, but that is in paper. Of course, RBI does a lot of checks and balances, and then NOF remains at 2 crores. Even under the scale-based scenario, RBI said that yes, all new companies or even existing companies who want to do only investment activities without customer interface, without public funds, you can be categorized as a type 1 NBFCs. So a few companies thought that, okay, we are NBFCs, we have got the license as an ICC, we are not doing investment activities. We are doing investment activities, we are not having public funds, we do not give loans. So therefore, we presume ourselves to be type 1 NBFC and would have only net own fund of 2 crores. That should suffice, and we are not required to have a NOF of 5 crores. But that is, I'm sorry to say, is not a correct understanding of law. I think there was a representation by industry to RBI, to which RBI had clarified that no, all those licenses which you had applied in 1997 or prior to 2016, when the concept of type 1 was not there, all those companies are type 2 NBFCs, meaning thereby you have the right to accept public funds, you have the right to lend to customers, you have right to have customer interface. So those are type 2 companies. Now, in the event you want to convert from type 2 to type 1, so that you are able to live with a NOF of 2 crores only, then you have to apply to RBI for conversion. And conversion again is a very complex process. It is as good as a fresh registration. So RBI evaluates yourself as if it evaluates a new company. The only line of difference is that you need not keep a fixed deposit of 2 crores. So rest all other parameters, RBI will evaluate to the extent that whether there are fit and proper directors, whether there are any complaints against the company, whether the directors, the shareholders have appropriate civil score, all the qualitative characteristics which RBI does for a new NBFC on the same parameters, RBI will evaluate you as a fresh company. Fresh company, the difference being, as I said, you need not have a fixed deposit of 2 crores kept separately in a bank free of lien. So this is one difference. So therefore, companies who have not attained the NOF of 5 crores by 2025, even they are not accepting public funds or customer interface, not having customer interface, they cannot plea on the ground that since I am not accepting public funds, I should be denied, I should be entitled to retain my certificate as a type 1 NBFC, one has to apply. Now the question arises that 31st March 25 gone, whether at this stage, if you apply, whether that would be within the four corners of law, that time will tell. But going by the past experience, unless you are received a show cause for cancellation of an NBFC, one has a very good case to argue before a show cause is issued that, say, today you apply for a change of license, or today you apply for amalgamation of a company with another company on the ground that you have not been able to, achieve the requisite NOF of 2 crores, one has a good, reasonable chance of success, I would say, reasonable chance of success, going by the past precedents in the year when the cancellation had happened in 2017. Now, I would also like to take you through one important court case which had happened, one important writ which was filed by the Federation of Indian Financiers Association. They had filed a writ before the Madras High Court. That was sometime in April 25 when Madras High Court, and they wanted a blanket stay on the NOF, but on the NOF of 5 crores and 10 crores, which the Madras High Court had refused, and the matter was, sent to the CGM, DNBS section, the NBFC sections to examine their plea. Now, before the DNBS Mumbai, before the CGM Mumbai, they made a submission that if you are increasing the NF from 2 crores to 5 crores and thereafter to 10 crores, this would wipe away a number of smaller NBFCs. So you keep this increase in limit in abeyance or give some extension of time to all the companies so as to achieve the NOF of 5 crores and 10 crores. Now, RBI said that in 2021 they had issued a discussion paper, and in the discussion paper RBI had put a cap of 20 crores, not 10 crores, and RBI wanted that every company should achieve NOF of 20 crores. And what reasons they gave that they said that from 97 to 2021 there has been increase in price levels, GDP, risk perception of the NBFC sector, plus there are regulatory requirements, need for IT enabled processes to address KYC, PMLA, all those risks. Again, they did not want to have a low entry barrier, and this is that in case the entry barrier is very low, this may raise the chances of failure from poor governance of non-serious players. And also they wanted that NBFC should be adequately capitalized so that they are able to absorb all these shocks. So when this NOF of 20 crores was proposed, but again getting the feedback from the stakeholders, they retained it at 10 crores, and they gave two timelines. In the year 21, they gave two timelines that achieved 5 crores by 25 and 10 crores by 2027. So when the industry gave the representation, RBI said, look, this figure, although I have enabling powers to raise the NOF to up to 100 crores, which was again conferred by the Finance Act 2019, that RBI can raise the NOF to 100 crores. So they said, even though we had the power up to 100 crores, we proposed 20 crores, and on request from industry, we kept at 10 crores. Now we have given you 3.5 years time to achieve 5 crores and another 2 years to achieve 10 crores. So the timelines given is quite well enough, quite well thought. And if the companies have not availed all measures to augur the capital resources, then RBI cannot be much of help. They are liable to face regulatory actions. They had various options before their disposal. They could have do amalgamation, merger, capital restructuring, different propositions. But since they have not been able to do so, so they have to face regulatory action. And at the same time, RBI said that, look, considering the need of smaller NBFCs who do not want to have access to public funds customer interface, we have even proposed a type 1 structure where you can do your business with the NOF of 2 crores. So that option, even if the companies have not exercised, then they have to face the strictures from the regulators. Now, so these were the basically findings. These were the submissions of the representatives of the association and before the NBFC cell Bombay, and these were what RBI has said. But again, then finally they said, okay, considering the representation by the industry, it would not be a strict jacketed rejection that anyone who fails to achieve NOF of 5 crores would face deregistration. We will evaluate it on case by case, and in the event it is found that they have bona fide reasons or they have taken steps. For example, many companies have applied to RBI, say for example, for change in control. And like we had done a case prior to March, we had applied to RBI in case of an NBFC for change of control. The NOF was 2 crores. And in that, along with the application for change of control, we had given a path forward as to how would we achieve the NOF of 5 crores. So with the NOF of 2 crores in place, RBI had granted, change in control, change in shareholding of the company, and it is now upon the new management subsequent to 31st March 25 to attain the NOF of 5 crores within a short period of time, which the RBI has prescribed. So there may be cases where NOF of 2 crores may not have, 5 crores may not have been achieved because merger is in place for which approval of RBI has already been given for merger. So I think those cases would also get away through, will not face any regulatory action. There may be some cases where applications are pending for increase in capital, change in shareholding, perhaps again those cases on merit once evaluated, I think even though March 25 you have not attained the NOF of 5 crores, one could live with it because maybe RBI would grant successively subsequently approval. So all it depends on case to case of the entity as to how it is able to demonstrate as to why I was not able to achieve an NOF of 5 crores and what steps are taking. But having said that, and based on the experience we had in 2017, also when many of the companies faced registration, the sooner the better one complies before any show cause is issued. One may be able to have a good case to argue that having already achieved the NOF of 5 crores before your show cause. Although if you see the scale-based regulation, the scale-based regulations clearly says that NBFCs who fail to achieve the NOF of 5 crores by 25 and 10 crores by 27, 31st March 25 and 27 will not be eligible to hold a certificate of registration. So that is clearly mentioned in those guidelines. They do not continue to remain eligible. But as I said, going by the past experience where many companies have challenged, cancellation, even though they did not achieve the NOF of 5 crore of 2 crores before 31st March 27, a few companies found favor who were able to demonstrate successfully having achieved NOF of 2 crores even subsequent to 31st March 27. So this is all about, about NOF, net own fund of 2 crores and 5 crores. Now, even for type 1 companies and type 2 companies, as I said, so many companies have still not applied to RBI for conversion to type 1. I said sooner the better. What regulator would perceive to your application, that we cannot comprehend at this stage, but the advice to all fellow professionals would be said that irrespective, like you have an NBFC, you have not achieved the NOF for 5 crores. Either you achieve it 5 crores today before RBI takes any steps. You are a type 2 NBFC. You want to convert type 1 because you do not want to have customer interface public funds, nor the client is able to manage to raise the NOF to 5 crores. Apply to RBI for conversion to a type 1 NBFC as good as a fresh application. All applications are to be done through Prava portal. Earlier in the Prava portal, there was no application for conversion to type 1, but now recently they have again, initiated the process. So you have to file an application with Prava portal with a copy to RBI Mumbai, with a copy to RBI Calcutta in hard copies, and application should be as detailed as possible. So many points which you are required to give with the applications, one has to envisage what RBI would possibly ask to ensure that the directors are, most important is the directors, the shareholders are fit and proper. They are not subject to any regulatory rigors. Many of presently, as I am told, in RBI even sends to the different regulators, be it the GST cell, be it the income tax, be it the enforcement PMLA cell, to inquire about the directors as to whether they are fit and proper. RBI is very, very concerned that unscrupulous persons, unqualified persons should not be on the boards of NBFCs, and only persons who are fit and proper in terms of RBI guidelines should be on the board of NBFCs, and this applies even to the shareholders. So if you have any corporate as a shareholder, which is subject to cases before NCLT or subject to income tax use demands, and if in the event there is an unfavorable report from the income tax department, to the extent it relates to that shareholder, possibly the company would not be allowed the certificate of registration. So best option is the company either should raise it or the company should apply to RBI for conversion to type 1 NBFC through Prava portal with hard copies to Bombay and Calcutta office. So this is in summary something about the net owned fund. Now coming to the second point on regulatory prescriptions, many of the companies which happen to be in middle layer, especially a few companies also in base layer, in fintech companies across Calcutta, whether you are in base layer, middle layer, all have been subject to inspection. And a few pointers from inspection. Number one, minutes books not maintained properly. Second, agenda and backup papers not maintained. When RBI comes for inspection, it even wants to see your minutes of the meeting, your agenda, along with the agenda, what backup papers did you send? You are a investment company. You give investments. You do not do any appraisal of the investments. You do not place before the board the investments. You do not have any investment policy, or investment policy is quite vague, or you do not comply yourself with the whatever you have mentioned in the investment policy, because many a times company frame a policy without seeing what is their actual philosophy of investments, and they violate themselves the investment policy. Their agenda papers are wine liners. They do not have any backup papers. So RBI is, when it comes for inspection, it wants minutes, it wants agenda of board meetings in total. Then when it comes to loans, you do not have a proper fair practices code, neither in interest rate policy, nor a client identification program, nor a PMLA policy, nor a policy in relation to CIC. For CIC also, a number of policies are required to be framed and they need to be complied with. So those are not available. Companies give loans, but there are no appraisal documents. It is as good as by one piece of exchange of a letter, you just give a loan, or even that is not there. Companies take year-end confirmation, so that would not be is sufficient. You, as per fair practices code, whatever documents you are required to have in terms of a loan agreement, in terms of a key fact statement, appraisal of loan, post disbursement supervision, filing of the records with CKYC, uploading monthly credit data to NESL, as well as CIC post disbursement follow up, all those need to be maintained. And if your account happens to be SMA 0, 1 or 2, in the sense if it is overdue beyond 30 days, 60 days and 19 days, there is a repository of large information credits. You have even to file information to those repository in case even uh, uh, an account does not become NPA, but it falls overdue beyond 30 days. So all those again are required to be reported. So those things are not there. So these were some of the aspects. Another aspect is regarding the compliance with IT directions. Hardly companies comply with IT directions. They do not have a computer. They do not have an office. They do not have a rental agreement, even with their fellow group companies, or even with the promoter. They have a IT network in one particular company for which there is no resource sharing agreement. Again, that is a very important point for RBI as to why the company is not compliant. When it comes to loan, interest is not charged quarterly. NPAs are not being marked. Interest is served as at year end, or maybe after 1 year, 2 years, there are running account balances without proper documentation. So these are cause of concern again for RBI. Many companies have not onboarded themselves into FinNet 2 platform. Neither they have registered the principal officer, designated director in the FinNet 2 platform. Again, that is a concern. Companies are not filing returns with 4 CICs, not have taken membership of those 4 CICs. Again, those are a cause of concern. Companies changed management. So RBI says that any change in management, including change in directors beyond 30%, requires prior approval, excluding independent directors. So you have 2 directors, you want to resign one and appoint one, or you want to appoint one. So there is a 30% change. So prior approval is required. And when you make a prior approval, again, prior approval has to made through Prava portal, and entire hard copy, one set you have to file with the local RBI office. So many companies complain that since we do not get the approvals in time, we just appoint the directors. But RBI has become extremely strict with all these aspects. So if a director is appointed without prior approval, RBI, and if a post facto information is given to RBI, or a post facto approval is sought, RBI, what we have seen in the past for the last 4 or 5 years, RBI, prior to 2020, they used to regularize it with a warning post facto. But now, post to 2020, what we have seen, RBI does not give a post facto approval. It rejects, and then again, the director has to relinquish the position and again seek fresh approval and thereafter appointment. So this is a challenge, and many companies who have done have faced even penalties from RBI for this. Companies who have not complying with fair practices code. There was a recent case where on inspection, RBI found that a company did not have membership of 4 CICs, nor it was filing returns there too, obviously. It was not complying with fair practices code. RBI levied a penalty of 11,25,000 on that company. So again, these are the few points which I have said. There are a large number of observations when it comes to RBI inspections. So this was on this. Now coming to change in shareholding. many companies change the shareholding over time, and it is presumed that 26% means 26% at a point of time. 26% should be considered in multiple ways, to the extent that if there has been a progressive change in shareholding since the last approved shareholding beyond 26%, either of a single person or persons taken together, this amounts to change in 26%. Even a change in shareholding from 25% or 24% to further acquisition of 2%, 3%, which results in change in shareholding from 24 to 27%, that also requires prior approval. One would say that my shareholding, say there were four shareholders, each holding 25%. And one shareholder has transferred 2% shares to another shareholder, resulting in 23% and 27%. One shareholder reduced from 25 to 23, another shareholder increasing from 25 to 27. 26% is a mark which blocks special resolution. It gives controlling power to some extent to those shareholders holding 26%. So even that would require a prior approval from RBI. So therefore, many companies who have changed the shareholding, who have changed the directors without prior approval. So often a question arises, if I do not seek approval, what would happen to the fate? The fate is as such, RBI, the directors, one could definitely argue to say that director who has been appointed without prior approval from RBI is not a validly appointed director. What consequences legal would follow, one would have to evaluate it. But if a director is appointed on a board of an NBFC, which required prior approval from appointment, and therefore a director, if he is appointed without prior approval, would not be a validly appointed director. Similarly, in case of change in shareholding beyond 26%, which would require approval from RBI, and if approval is not taken, often a question would arise, other than regulatory action, as to whether the acquisition of shareholding is bona fide because it has been acquired without sanction of RBI. So these are certain legal questions for you to evaluate as to what would be the position, because still now even RBI has not gone to extent, but tomorrow it may again go to an extent. So there may be a case where there has been a series of change in ownership of the companies from X family to Y family to Z family, and tomorrow say the transfer from X family to Y family was without prior approval of RBI, Y to Z was again without prior approval of RBI. Tomorrow, if the regulator wants to take any strictures, impose any strictures or take actions against the so-called acquirers and so-called sellers as to it is not a bona fide buy and sale transaction. The question may arise in future as to what will happen to the company, whether the ownership acquired by the third family from X to Y, Y to Z, acquisition of shares by Z, assuming the RBI does not approve, treats it illegal in terms of RBI Act, what would happen to the fate of the company? Again, these things have not yet come, but again, it is on the radar of RBI. This may come eventually. So therefore, one has to be very, very careful if you have not applied for change. So in cases when we, approached RBI that this has happened, look, we have changed the shareholding. Now what is to be done? It was under the bona fide belief. RBI has rejected the application. Again, you have to apply afresh, because important is the transaction of transfer of shares must be approved by RBI. If it is not approved by RBI, there may be consequences, as I said. So therefore, we apply. RBI will give a one-liner letter that supervisory concerns. You have not sought prior approval. It is rejected. So when we approached RBI said that you again reinstate the back position, come to us for approval, then transfer the shares. So this at times may become difficult, but then we have to explore again with RBI as to how is it possible. So if there are selective cases of transfer and we are a very compliant company, we have to make out a case to RBI that, look, this has never happened in the past. It was a one-time fault. Please grant us excuse. So perhaps if you are able to demonstrate it successfully, again, RBI may allow the application, may or may not allow the application, but we feel that yes, in isolated cases, RBI will allow the application. Now, coming to the last point before I take questions is on a settlement of shares on trusts. Many times we have companies want as a matter of succession planning that they transfer their shares to a trust. SEBI allows transfer of promoter holding to trust subject to compliance with certain conditions. We have approached RBI again to let the promoters transfer the shares to private trusts with the beneficiaries being confined to the promoter and their spouse and their lenient descendants only. So RBI is not comfortable with the trust structure. And recently, I think it was yesterday only where a few listed companies, it was published in media that a few listed companies had applied to RBI again for settlement of shares on the trust, but RBI was not comfortable with the trust structure. But again, one has to demonstrate to RBI that recently, a month ago, we had again a program with RBI officials where I said to RBI that assuming SEBI allows and assuming the fit and proper criteria is followed, why RBI should not, allow settlement of shares on trust, provided it is confined to Indian jurisdiction. Of course, for foreign trusts, RBI is not at all comfortable. So they have outright said that in case you settle shares on a trust which is created abroad, we will not allow transfer of 26% shareholding. But to trusts which are formed and registered in India, beneficiaries are lenient descendants of the existing shareholder. We told RBI that SEBI allows promoter families to transfer the shareholdings to settle the shares in the trust without triggering the open offer requirements. So on similar lines, you evaluate the fit and proper criteria and allow such promoters to settle their shares in trusts. So to which RBI again said that it will evaluate case by case, but again, one has to make out a case, and if the RBI is satisfied, because RBI needs satisfaction on what ground? The main ground is that on the fit and proper criteria of the promoters and the shareholders. So therefore, if you are able to demonstrate fit and proper criteria for the promoters, for shareholders, their creditworthiness, their identity, so I think RBI should allow. Again, one has to keep on trying all these things. Now, coming on last on change in shareholding, there have been many cases where, say, shares of an NBFCs are held by a company, say 50%, 60%, and there is a change in shareholding of that company. So these are cases of indirect transfers. So RBI, so any change in shareholding, directly or indirectly beyond 26% would require. Therefore, if you have a holding company with an NBFC as a subsidiary, say for example, and the holding company goes on changing its shares, the shareholding again, it is it would trigger the 26% change shareholding route, for which you have to seek the prior approval of RBI. So this is all about the three aspects which the chairman said that we should have a discussion given whatever is happening now. Any questions, I'll be happy to take. Amit, you can take forward any questions. Participant may raise their hands and post the questions, or they can put it in chat box.
Thank you so much, sir. There are a few questions already on the chat box. The first one is, sir, what will be the situation if at the beginning of the year the NBFC was a type 2, but during the year squared off its loan and become in the category type 1, though not applied for change in license with RBI?
So a type 2 is a type 2, type 1 is a type 1. You were formed in 1997, you got the license, or prior to 2016, you got the license as a type 2 NBFC, and now you say that I am not extending loans, I am not availing public funds, so I should be type 1. So this will not happen. You have to change your license from type 2 to type 1. as I said, I am not accepting loans. So today I am not accepting loans, but tomorrow I may accept loans. Now, I tell you, when last year RBI had done inspection of many type 1 companies which recently got license, and they found that they were availing public funds. Also, they were extending loans also selectively. So in that case, RBI asked them that since you were granted license only for type 1, how could you do this? And how could the members also did not report? So chartered accountants also did not report this fact to RBI that the client company has violated the eligibility conditions of COR. So RBI had written to the institute, and institute has also issued an advisory. If one can see on the website, they had also issued an advisory that companies who are granted type 1 licenses and have started availing public funds and granting loans, the auditor should report to RBI.
Another question has been asked by CA Vidya Jain. Sir, if one NBFC wants to convert from public limited to private limited company, how to take prior approval? Because Prava portal does not have that option, and we have mailed them, but no reply has come from their end. How long we have to wait?
Correct. You see, first thing, many a times we think that we write letters to RBI, and if RBI does not respond, we are within our rights to take the next step. That is not so. So if in Prava portal, they have not onboarded all the applications. Therefore, if all the applications are not onboarded in Prava portal, then you have to make an application directly to the Calcutta office of RBI. And conversion from limited to private limited is like a change of name. It is RBI treats the same as a change of name, although we may say in our parlance that it is a change of status of the company from limited to private limited, but for RBI it is a change of name. So if there is an option for change of name in Prava portal, you have to apply using that. If there is not, then you have to again apply to RBI, directly to RBI Calcutta office.
Another question has been asked by CA Apurva Maheshwari. A proposed director was not found to be fit and proper by the RBI while applying for his appointment in an NBFC. The reason cited was a prior change in shareholding exceeding 26% in another NBFC, where he is already a director, without obtaining prior approval from RBI as required in order to regularize the situation. Would it be advisable to reverse the said shareholding change in that NBFC and then reapply for the director's appointment?
So you have a case where if I've understood correctly, there was a company X in which there was director Mr. A. That company underwent a 26% change in shareholding without approval of RBI. Now, this gentleman, Mr. A, is proposed to be appointed in another company B. So when the RBI evaluated the fit and proper criteria, it said that this gentleman A is not fit and proper. Why? Because he has been on a board of an NBFC which has violated one of the conditions of registration. That is, you have to be compliant. You have not sought prior approval. Now, the first step would be the company should regularize this, get the 26% transfer cleared from RBI. So it becomes quite easy to say that we reinstate back the position. If that is possible on some grounds, if you are able to make out a case, because income tax provisions are there, companies law provisions are there. Therefore, if you are successfully able to make out a case that this sale never happened because it was required the prior approval of RBI, and whatever transfer also the company did was not correct as per law. Assuming that is being able to made out, then you apply afresh in the first company for prior approval. And once this is done, then you have to then appointment of Mr. A in the second company can only be, unless the first is regularized by RBI. You cannot. I don't think RBI will consider even your any that we are going in the first company for reinstatement, and now you grant us. So that is for RBI to see. You have to get the approval, the change from the first company cleared from RBI. Then only you can take the next step.
So the next question
and
is,
I think Apurva, if I have been able to answer, if Apurva is there, he can raise hand and ask.
Yeah, Apurva, you can talk now if you're there.
Yes, sir. Hi, Mohit.
So this is fine. I think I have made your point clear.
Yes, it's clear. But
Yeah.
as you had rightly pointed out, it's quite tough to get the shareholding again reversed because of income tax and company law matter. So if that cannot be
Assume,
done, then what
then
can be
there
the
is a
way out?
difficult. So if that cannot be done, assuming that cannot be done, therefore the 26% change in shareholding of the first company cannot be regularized. If it cannot be regularized, then the gentleman A who happens to be a director, RBI will never take him as a fit and proper director because it was under his nose that transfer took place. Why did he transfer the shares? Knowing well that it required RBI approval. This means he is a gentleman, he is on the board of directors who is not compliant with law. Then that is difficult. So first company should take steps to get it cleared. Only possibly then you can have Mr. A appointed in the second company.
Okay. So the next question has been asked by Mr. Vikram. If NBFC had given loan to group company, then whether it will be construed as customer interface, and for CIC registration is to be taken.
Yeah. So Vikramji, this was a point many professionals have been raising for years that group companies are not customer. A company is a company. So when you are extending loan to a company, whether it is a group company or non-group company, new group company, it is a customer. And and many a times we think that how can group companies be customers? So let me also give you a very good example. Uh, you have 4 or 5 family companies. You think that these are not my customers for the simple reason that you own or the promoters own all the 4 companies. But the definition of group is very extensive and it includes even related parties. So therefore, it may so happen that you are a director in a company which is owned by you. You are also director in another company which is not owned by you, owned by somebody else, but they happen to be group companies because of the commonality of the directors. Now, in case the first company extends loan to the second company and the second company defaults and the second company takes a plea that I am not a customer because they are my group companies, then it would be quite unjust. So I'm giving some rarest of the rare examples. But so loan is a loan, a customer is a customer. When you give loan even to a group company, you have to evaluate all the loan parameters. So many a times what happens, we have a company which is running into losses. The NBFC does not have any business relationship with that company in the context that is neither a subsidiary nor associate. Still, we extend interest-free loans or low interest bearing loans to those companies, knowing very well that these companies do not have the ability to pay. They have negative net worth. So RBI does not, consider it as a sound business proposition. And when it comes to inspection, it comes down very harshly on the NBFC giving loans as to how could you evaluate giving loan to that company, even if it happens to be your group company. So customers are customers. For CIC again is mandatory, as I said. In one case recently, a company was not a member of 4 CICs, not filing returns. Beside other violations, RBI imposed a penalty of 11.5 lakhs on that company. Yeah.
So there is another question by Mr. Abhilash Gupta. If there is a change in designation of a director from non-executive to executive director, does that count as change in management?
No, that will not count because there is no change in directors. There is a change in position. It is not a change in directors. So that is fine.
Okay. Uh, and another question by Mr. Susil Tansukha. Shareholding changes within promoter group and consequences if not taken prior approval.
So as I said, Sushilji, if prior approval is not taken, then obviously the company is under violation of RBI Act. RBI may impose penalties. RBI may not give prior approval. As I said, it is a legal point to be evaluated that in case change in shareholding happens without permission of RBI, whether it is a valid transfer as well, whether it gives the valid ownership as well, to which again, in my discussion, I had raised this point because RBI is also contemplating that because when we approach that okay, you give a post facto approval to which it was not, RBI was not agreeing to this fact, and then during discussion a point raised that how could such share transfer be deemed to be valid if we have not given the prior approval. So RBI perhaps has not yet taken this stand, but eventually it may take that stand also. Plus, as auditors, let me say our points as auditors. If our company has acquired 26% shares of an NBFC, shares have acquired, consideration paid, transfer made, but approval of RBI has not been taken. So again, it is a point for the auditor, maybe to even qualify his report, that these investments which have been acquired are not subject matter of, have not been validly acquired in terms of RBI Act. So to again reinforce my point, so there was a case where a company went to NCLT for merger, for which they did not seek prior approval from RBI. So regulations say that before filing an application to NCLT, you have to seek prior approval. You have to seek approval from RBI. So the company went parallelly, filed application with NCLT parallelly, and went to RBI for approval as well. RBI rejected as to how you could even go to NCLT. And during our conversations off the table, RBI has even said, tomorrow if NCLT gives you an approval for which we have not given you prior approval, we may again file an application to NCLT to reverse the merger because it was not a validly approved merger since it did not have the RBI approval. So the message is, if there is any regulation which requires approval, we have to seek. We do not have any mechanism for compounding. Unlike in FEMA, we have mechanism for compounding, but of course we should also try that route, that since the transaction has happened, money has changed hands, it is not possible again to recover back the money. I do not have any other option now. If you do not give the approval, my money which I have put for acquisition of stake, would turn bad. So all those pleas you have to make approval to RBI. So in few cases we have voluntarily said to RBI, okay, this has happened, आप penalty लगा दो, penalty लगा के मुझे regularize करो.
Another question, sir. NBFC changed its shareholding more than 26% by way of gift and inheritance due to abnormal situation like death in the family due to COVID 2021 without approval from RBI. Now notice has been received from RBI that it is a non-compliance. How can I explain to RBI and what are the chances that RBI will forgo that non-compliance?
So again क्या होता है ना, death हो जाता है. You see, these are something not normal situation. So if it happens to be by will, and if you are able to obtain a probate, I think then you have a very, very good case to argue, because a probate is a court approved document, a document given by the court. Basically a stamp on the will is a probate. And first point. Second point, in case, again, assuming you have not taken a probate, it has been transferred by a will, then you can definitely make out a case to RBI that it is not a usual transfer, because they talk of transfer, not transmission. But RBI, you cannot harp on the words of the regulation and say that you have talked of transfer, not transmission, because in case of a death, it happens to be a transmission. But again, you have to demonstrate yourself, and I think it is a good case to say that on case of death, even if there is a change in 26%. But of course, I would have said that you should have written to RBI for prior approval, obviously for prior approval, or with prior intimation you should have done. Even if it is not done, it is a good case to write to RBI that it is not a case of a transfer, but transmission happening by death, and whosoever had bequeathed the property, he wanted to bequeath to me, and I presume that the recipient is a fit and proper person. A good case to argue.
And sir, last question for the day: will preference share capital be considered for the NOF calculation?
I think the regulation says compulsory convertible preference shares within 5 years for NOF. Not all preference shares. It has to be compulsorily convertible preference shares.
Great. Thank you so much, sir. Thank you all the attendants of today for this wonderful session. being taken over by CA Mohit ji. And thank you for this question answer round, which shows clearly that the audience has taken a keen interest in the topic and your thoughtful responses. Now, on behalf of EIRC and all the participants, we extend our sincere gratitude for your time, expertise, and willingness to share the knowledge with us today. Thank you for your contribution to the session. Thank you so much, sir.
Thank you. Thank you.
To all participants for joining us, and do stay tuned. We'll be coming with all the session on alternative dates. That is Monday, Wednesday, and Friday on the various topic, and we keep you updated. Thank you so much.
Thank you.